In this video, I wanted to analyze Scott's Miracle Grow. This was a suggestion by a super investor member, and I wanted to research and analyze this company to see if it's a good investment. Now, Scott's Miracle Grow is really well known. I know them for the sod treatment and fertilizing for one's home, and that's where I got to know them. In fact, I'm familiar with their brand that I see at Home Depot, Scott's. Miracle Grow, I know that if you have a vegetable garden, that's a pretty good product to use. They also have like weed killers like Ortho and Roundup. And I know Roundup was kind of at the center of some lawsuits and controversies. They have other types of products, I think more industrial products to help centers that grow plants and so forth with. Overall, this is a well-known company. I'm going to take a look at their fundamentals, put them in evaluation, and see if they're priced too high or too low. Also point out what I think are positives behind the company from a fundamental perspective, as well as some risks that are negatives about the company. So let's take a look. Let's analyze Scott's Miracle Grow, starting with their fundamentals, and then I'll end up with a good valuation or a valuation for Scott's Miracle Grow. Let's get started. Over the last 5 years, this stock price has really gone down 67.3%. And when I look at a chart like this, it's either the market has it right, this business should be sold off and brought down in price, or it might be an opportunity. If you have a turnaround story, if you have a business maybe that had a couple of rough years, have figured things out, fixed the problems, and began to really grow their top line revenue and improve other fundamentals. The 1 year, not good, down 39%. Year to date, this one's down. This does pay a high dividend now. With that stock price really coming down, it's created a nice high dividend of close to 5%. But I don't like focusing on the dividend because it lures me into investments where maybe the fundamentals are telling me this is not a good investment. Making almost 5% is one thing, but losing 18% at the same time, it's just a bad recipe. This is a small cap at 3.14 billion, revenue of 3.44 billion. The company for the last couple of years, not growing much, and they actually contracted quite a bit in 2022 and 2023. They were growing nicely for a number of years, and it may have been that 5 year is because they were growing so well in 2019, 2020, 2021. Their stock price probably flourished and then really came down hard when they started to contract. Their gross profits are, for a materials company, they're okay. They're not going to be comparable to the most valuable companies on the stock market. Its cash flow is positive. It's not as high as 2024 fiscal year, which ends September 30th. Trailing 12 months is 244. These guys are going to announce their earnings on November 5th. So we're a couple of weeks away from them announcing. We'll see if they improve this free cash flow number. I'll use the trailing 12 months in my evaluation of the company. Their gross margins, 29.77. They're a materials company, so that's just what it is. They have to put a lot of money into getting the materials they put into their end products. They have production to bag and package these products and then take them to market. They have to pay for labor and so forth. So gross margins are lower than some of these really desirable industries and sectors. The profit margin is really low, 1.54%, and the free cash flow yield is 7%. So nothing outstanding. It's quite minimum metrics here. These are investable if I'm getting a really well-priced company, and I feel like this industry is really going to have good days ahead. Let's continue our research. So looking at a couple of statistics, the balance sheet worries me because they have $2.47 billion of debt and only $52 million of cash. So you're paying a high dividend, but you have a substantial amount of debt. The debt to EBITDA is 3.9. Now the business is beginning to expand their profits. That's good. It's not contracting any longer. That's good. But maybe they can reduce that dividend and pay off this debt, because 3.9 labels this a riskier company. 3 is really the maximum that I like to go. 3.9 is above that maximum. So I'm actually going to use a higher discount rate to label this a higher risk investment. Looking at the forecast analyst, 6 of them are covering the stock. They really like the stock. They think it's discounted by 26%. They're focusing in on earnings per share. And I would say the forecast looks decent. You have a little bit of growth for the year that they are going to close in 2026 on September 30th. So just a tiny bit of growth, and then 27 will follow a little bit of growth. On the profitability, that's really growing. So these numbers look really good. I'm going to use these numbers in my valuation when I value the company based on earnings per share. And their PE ratio is going to drop unless the stock price rises. This may be a nice long-term hold, but I'm not sure just yet. I'm worried about a couple of their fundamentals. So let's continue on. I valued Scott's Miracle Grow by looking at their free cash flow, setting up a forecast, and then doing a net present value calculation on their forecast of cash. I also looked at their earnings per share, and collectively, I think the stock price is priced 18% too high. The value of each share is $44. It's being priced at $54. So this stock is a sell for me. There's just too much going on that's negative. You have a balance sheet that's not in good condition. They have a high debt balance, but they're paying a high dividend. It's like, I like, for example, what Amazon really has as a discipline is they're committed to making the business stronger, to obsessing on the customer, making Amazon as valuable as they can for the future. Future being, how can we drive higher revenues, higher future free cash flows, higher profits? We may have to sacrifice today and make some changes or some decisions that the market may not like, and it drives down the stock price. I'm fine with what Amazon's doing, but in this case here, it's the opposite. You have a high dividend, and you need to pay off debt. So I don't like that behavior that I'm seeing with Scott's Miracle Grow. I may not be completely understanding the situation, but just high level, that's what the metrics are telling me. So I don't like that type of behavior from management. So this one here is going to be a total pass for me. And that concludes my research and analysis on Scott's Miracle Grow. I hope you found it interesting, and I appreciate the Super Investors nomination of this stock. Thank you for watching the video. I hope you found it interesting. Would you like more access to content like this? Consider being a paid member. You get more real-time access to videos when they're published. You also get access to a Discord and many other value add benefits for investors, like access to the tools that I use when I analyze stocks. Take a look at the 4 levels that are available on the homepage of my YouTube channel. Thank you.